If you had to plan an audit from scratch, where would you even start? Hey everyone! Today, we're walking step by step through how auditors plan their overall audit strategy, from choosing the audit approach to understanding when to test controls, how to use experts, how to leverage internal audit, working with service organizations, group audits, and a full summary example at the end. Before we jump in, don't forget to like this video, hit subscribe, and tap that little notification bell so you never miss an update from the channel. All right, let's get started. When auditors begin planning an engagement, their very first job is to design an overall audit strategy. Think of it as the game plan for the entire audit. This strategy sets the scope of the audit, the timing of audit work, the resources needed, the audit approach, substantive, combined, or systems reliant. It also guides the audit plan, which contains the detailed audit procedures. A strong overall strategy ensures the audit will be efficient, effective, and focused on risk. Now let's transition into one of the biggest decisions in audit planning. Should you use a substantive approach or a combined approach? This decision depends entirely on risk assessment results and on whether internal controls are effective enough for the auditor to rely on them. Let's break down both options. A substantive approach means the auditor does not rely on internal controls. Instead, they focus heavily on substantive procedures such as detailed testing, vouching, tracing, recalculations, confirmations, substantive analytical procedures. This approach is used when controls are weak or poorly designed. Controls cannot be tested. Testing controls would be inefficient. The auditor expects high risk of material misstatement. In other words, if you can't trust the controls, you rely 100% on substantive work. A combined approach means the auditor relies on controls plus performs substantive procedures. This is appropriate when controls are designed effectively, controls have been implemented properly, controls are expected to operate effectively. Testing controls is more efficient than testing every detail. The goal? To reduce the amount of substantive testing required. This leads us into evaluating internal controls. To decide whether controls can be relied on, auditors assess design effectiveness. Does the control make sense? Implementation. Is the control actually in place? Operating effectiveness. Does the control work consistently? If the answer to all three is yes, controls can be tested and reliance may be placed on them. If not, substantive approach all the way. Let's walk through an example. Imagine Northern Peaks Manufacturing, a company with several automated controls in its revenue cycle. Management boasts that the system is foolproof, and the auditor wants to rely on these controls. But during walkthroughs, the audit team discovers missing approvals, inconsistently applied control steps, weak segregation of duties. Even though controls look strong on paper, they aren't operating effectively, so the auditor cannot rely on them. They must switch to a substantive approach. On the flip side, Maplegate Apparel, another client, has strong, well-documented controls with evidence of consistent operation throughout the year. Here, a combined approach makes perfect sense. With the approach determined, let's move into a related topic that's especially important in first-year audits. In a first-year audit, auditors must obtain sufficient evidence over opening balances. This includes prior year ending balances, accounting policies, significant estimates, contingencies, historical errors or adjustments. Auditors may review prior financial statements, working papers if accessible, tax filings, bank statements, historical support for major accounts. If opening balances are misstated, it may affect current year results and require adjustments. This also transitions nicely into another area where auditors sometimes need outside help. Sometimes auditors encounter areas outside their expertise, like fair value of complex instruments, environmental obligations, actuarial liabilities, specialized inventory. In these cases, auditors may need to use a management expert or an auditor's expert. Key considerations include expert competence and qualifications, objectivity, quality of work, reasonableness of assumptions. Auditors must evaluate, not simply accept, an expert's findings. When an organization has an internal audit department, external auditors may be able to use their work, but only if internal audit is competent, objective, independent, systematic, and thorough. If these conditions exist, external auditors may Rely on internal audit testing. Use their documentation. Reduce external audit work. If not, the external auditor proceeds independently. Many companies outsource parts of their operations like payroll processing, IT hosting, or transaction processing to service organizations. Auditors must understand the nature of services provided, risks introduced by outsourcing, how controls at the service organization operate. Often, this relies on SOC reports, such as Type 1, controls designed properly, Type 2, controls designed and operating effectively. These reports help auditors assess whether they can rely on outsourced controls or must perform more work on the user organization's end. For companies with multiple components, subsidiaries, divisions, or locations, the auditor may carry out a group audit. Key considerations: significance of each component, risks at the group and component level, reliance on component auditors, materiality allocation, communication requirements. The group engagement team must ensure the component auditor's work is sufficient and appropriate. Let's wrap everything up with a quick recap. The overall audit strategy sets the foundation for the entire engagement. Auditors choose between a substantive or combined approach depending on controls. Effective controls enable reliance, weak controls do not. Opening balances matter, especially in first-year audits. Experts can be used, but their work must be evaluated critically. Internal audit may help if they're competent and objective. Service organizations add risk. SOC reports are key. Group audits require coordination across multiple components. Mastering these decisions ensures the audit is focused, efficient, and risk-responsive. If you found this breakdown helpful, make sure to like this video, subscribe to the channel, and let me know in the comments what topic you want covered next. Thanks for watching Canada Accounting Insights, and I'll see you in the next lesson.